After weeks of calm, Spanish financial markets are bleeding once again. Spain's fate seems certain. A bailout is coming. But Prime Minister Mariano Rajoy tells the Wall Street Journal he will only seek aid if borrowing costs stay too high for too long. If that's the case, then he won't like our chart of the day. 10-year Spanish yields shooting higher, up through 6%, after the Bank of Spain said the economy continued to contract at a significant rate in the third quarter. I'm Jamie McGeever, and this is today's Market Pulse. Well, I'm joined today by Peter Chatwell, interest rate strategist at Crédit Agricole. Peter, the biggest sell-off in Spanish bonds in a month, and we're back above 6%. Is there more to go here?
Well, the problem that we've got, and I think one of the reasons that we're getting this sell-off, is that investors are really cautious because of the amount of event risk there is this week. You know, we've got the budget, we've got the probably month-end review of Spain's rating from Moody's. We've got these regional elections which are surfacing now. So there's a lot going on. Most of it is in the future, but in the near-term future. So it's just a reason to avoid the market. For those who are cautiously long, that means just pairing those long positions.
So is this a case of long liquidation, or are we actually seeing clients open up short positions in Spanish bonds?
All I'm aware of is some small long positions being liquidated. And I should emphasise that volumes do appear to be very thin. It's the futures which appear to be leading things.
So, in your conversations with clients today, what's been their biggest concern about Spain?
Nothing new, really. It's just that we've got some major event risks at the end of the week. It's not really worth having the exposure. The carry in Spain is very nice, but it's nothing worth having some exposure to because the feeling would be if all turns out well this week, then they can buy in later on, next week if need be.
I just mentioned in the intro there, obviously 6%. A couple of months ago, the big number was 7%. How significant is this 6%, do you think?
It's not significant. The only interesting point would be if it changes the Spanish government's mind. Perhaps it serves to focus them a bit further on meeting the conditionality of OMT.
Of course, so any conditionality is going to be it's not going to be readily accepted by the people of Spain. We've seen large protests overnight. Is that a worry for investors?
Yes, certainly. So it's one of the reasons that we're seeing these positions just being paired. It all goes to increase political uncertainty, and really that's what the ECB's Draghi's announcement about the OMT has done. It's heightened the focus and the intensity on the Spanish government. So now when we've got signs of unrest on the streets, and when we've got the possibility of regional elections coming earlier, it increases political risks. So it's negative for Spanish debt in the very near term. OK, that's Spain. Just want to finish up on Germany. A Bund auction today. Technically, it failed again, and not for the first time, of course. But with borrowing costs at only 1.5% roughly for 10 years, it's not that bad for Germany, is it? No, correct. It's still below the ECB's inflation target. I think it still shows that the monetary policy transmission mechanism is very much broken. There's still a huge flight to quality in place that's yet to be unwound. There's not much else to say there, other than just to emphasise that the auction failed, but now it's just up to the Bundesbank to issue into the secondary market. It may weigh on the Bund for a couple of days, but that's all. It's not really a big deal. Peter, thank you very much. Well, that's it for today's Market Pulse. My thanks there to Crédit Agricole's Peter Chatwell. Do check out our earlier show with Reuters breaking views on how the latest wave of Iberian protests are a real threat to Spain's austerity drive. I'm Jamie McGeever. This is Reuters.